Hello and welcome back to our final demo video dealing with Chapter 9. And we're going to work on problem 9-5B. This will coincide with your 9-5A. I'm on page 461 and 462 in our textbook. And they tell us that the disposal of plant assets is what we're going to be working on here. And they tell us that Canyon Company has a used delivery truck that originally cost $24,200. Straight line depreciation on the truck has been recorded for 3 years, and it has a salvage value of $3,500. The useful life is 6 years. The last depreciation entry was made at the end of the 3rd year. 4 months into the 4th year, Canyon disposes of the truck. Okay? So they give us basically A through E, and they want us to go ahead and record those. Super easy to do, okay? It really is. So think about it this way. We are starting year 4, okay? So there's already accumulated depreciation associated with the truck. We just need to book for the 4 months of the 4th year. The next thing we need to do is sell the truck at 3 different values, one being the book value, the other being we receive $15,000 in cash. The other scenario says that we sell the truck for $12,000 in cash. Okay, and then we have a last entry that says, well, what if the truck is stolen and there's no insurance, right? How do we get that off the books? So before we go ahead and do anything, the first thing I want to do is kind of get our bearings, right? We can calculate what the book value is at the beginning of year 3, or I'm sorry, at the end of year 3. I think that's a good place to start. So they tell us that they use straight line. We know how to calculate straight line depreciation, right? We say that we take the cost, or the acquisition cost, minus the salvage, and then we divide by the useful life. Okay, so what is the cost of this vehicle? Well, they told us that it originally costed $24,200. They tell us that the salvage value is expected to be $3,500. And they tell us that the useful life is 6 years. Okay? So we can figure out what straight line depreciation is right here. I'm just going to say equals, open parentheses, my cost minus my salvage value, close parentheses, and I'm going to divide by 6 years. So that means that every year we should be depreciating this asset $3,450. Okay? So we already went through year 1, we already went through year 2, we already went through year 3. So we have 3 years of depreciation. So I want to know, what is the accumulated depreciation for this asset? Super easy for us to do. We're going to take our depreciation per year, and we're going to multiply that by 3 years. Our depreciation then should be $10,350. Okay? So, what is, and we'll say year 3 end. What is our book value? These are just separate calculations that we're doing to try to, so we can answer the problem, okay? And I think it's easier to take kind of like an overview version first, all right? So the book value takes our cost, which we know what our cost is. Our cost is $24,200. We're going to subtract out the accumulated depreciation, which ends up being that $10,350. Our book value at the end of year 3, that's J6. Okay. The book value, I'm just going to say BV, at the end of year 3 is $13,850. Okay. Guess what? That is the same exact book value when we start year 4. Okay. So we have our information here that's going to help us, right? So the first thing that they ask us to do in part A says, okay, what is the entry to book depreciation in year 4, the date of disposal, right? So keep in mind, we're in year 4, okay? So within year 4, they tell us that they dispose of it 4 months into the year, right? Yeah, 4 months into the 4th year. So that means I have January, February, March, and April. Okay, so I have 1, 2, 3, 4. I have 4 months that I need to worry about. Okay, very important that we understand this time frame that we're looking at. Okay, so for A, I need to debit, and I'm just going to merge and center here. And I'm just going to kind of create our journal so we can do our debits and credits. Okay, so the first thing I need to do for A is say, okay, I need to book depreciation. So I know right off the bat I need to debit depreciation expense, and I need to credit accumulated depreciation. For how much? Well, let's think about this. I'm taking 4 months, 4 of 12 months, or 4 months out of the year, I'm taking depreciation. I know what my depreciation is for the year, right? It's $34.50. So I could just take that and then multiply it by 4/12. Usually helps if you put the right numbers in. 4/12. There we go. Okay, so we get $1,150. That is the depreciation that we get to take for those 4 months, right? We have to take those depreciations or depreciation for those 4 months because we're using the machine, right? Or we're using the travel or delivery van, okay? So I'm going to debit insurance expense for that amount. I'm going to credit accumulated depreciation for the same amount. Okay, so that's journal entry A. B says we sell the truck for cash at its book value. Okay, so for B, we know that we need to get it off the books. We need to get rid of the accumulated depreciation. We need to book the cash, and then we need to figure out what is our gain or loss. Well, since we're selling at book value, there's not going to be a gain or loss on the disposal of this truck, right? The only time we have a gain or loss is when the proceeds that we receive is either higher or lower than the book value, okay? So what I'm going to do is I'm going to come down here and I want to say, okay, what is my book value of this asset at disposal, meaning 4 years and 4 months worth of usage? What is the book value at that point in time? Very easy. I take my cost, which has not changed. It's still $24,200. Okay. Now I need to calculate what is my accumulated depreciation. It should be ACCUM, sorry. Okay. what is my accumulated depreciation? Well, at the end of year 3, it was $10,350, right? But I added some. I added 4 months worth of depreciation. So I need to take that into account. So I'm going to take my accumulated depreciation at the beginning of year 4, the $10,350, and to that I'm going to add the accumulated depreciation that I booked for the 4 months of year 4. My accumulated depreciation now is $11,500. So what's my book value? Book value now is $12,700. Okay? So I'm selling it for $12,700, right? So what's the first thing I need to do? The first thing I need to do is recognize that I'm getting cash, right? How much cash am I getting? Well, they tell me it's the book value. I already calculated the book value, $12,700, okay? What else do I need to get off the books? Well, I need to get this asset off the books and everything that's associated with this asset, meaning accumulated depreciation. Accumulated depreciation, contra asset account increases with a credit. To get rid of it, I have to debit accumulated depreciation. And I'm going to debit it for the $11,500. Okay? Now I need to get the asset off the books. Right? The plant asset, this delivery truck. Got to get it off the books. How do I do that? Very simple. It's an asset. I increase an asset with a debit. I decrease an asset with a credit. So I'm going to credit, we're just going to call it truck because it is a delivery truck. And I'm going to credit it for what it's on our books for. All right? What is it on our books for? It's always on our books at our acquisition cost. Our acquisition cost is $24,200. What did I do here? Well, I sold the truck, right? So record sale of truck for, how much did I get for it? $12,700. Okay. Now I want to make sure that debits and credits equal. They do. Because if I add up $12,700 and $11,500, that gives me the $24,200, right? These two added up equal $24,200. And my credit is $24,200. Debits and credits match. I'm good. Okay? Now, let's look at C. Now, the good news is, with C, here's where we're at. Right? Meaning, we have our cost, we have our accumulated depreciation, we have the book value. Now, they tell us that, oh, we sold the truck, but this time we sold it for $15,000 cash. Okay, no problem. What am I getting? I'm getting cash. I'm getting $15,000 of cash. Cash is an asset. We increase that with a debit. So I'm going to debit cash, $15,000. Simple, right? Just like we did it in part B. The next thing we need to do is get the accumulated depreciation off the books. What's our accumulated depreciation? It hasn't changed, right? It's still the $11,500. Okay? The next thing we need to do is get the asset off the books. So I'm going to get the truck off the books. What do I have to get it off the books at? I get it off the books of whatever it's on the books for. We always book plant assets at the acquisition cost. What's our acquisition cost? $24,200. Okay? If we add up our debits, we see that they equal $26,500. We have the truck, which is a credit of $24,200. There's a difference of $2,300. Guess what? That's the gain that we have. Gain on sale. And we said that's what, $2,300? There we go. Now, do debits and credits match? Sure do. 26.5 of debits for this transaction, 26.5 of credits in this transaction. Okay? Now let's look at the last one, D. D says we sell the truck, but this time we only get $12,000. Okay, no problem. We can do that. We're getting cash. Cash increases with a debit, so I have to debit cash for $12,000. Guess what? Got to get the accumulated depreciation off the books. For how much? Well, what's it on our books for? $11,500. Okay. So if I add these up, they equal $23,200. Okay. Well, I need to get the asset off the books. So I'm going to credit the truck account for $24,200. Why did I do that? That's the acquisition cost. That's what it's on the books for. Debits and credits do not match. They don't, right? There's a $700 difference. Our credits are $700 higher than our debits. So I need to book a loss on sale. Does it go on the debit side or the credit side? Well, I need this to balance. I need this transaction to balance. So I have to put it on the debit side. Why? Because our debits are $700 lower. Now I double check. Excuse me. My debits equal $24,200, which equal my credit. I'm good. Okay. So I hope you're noticing that there's a theme going on here whenever we book disposal, right? Number one, calculate what your book value is at that specific point in time. Okay. If we compare the book value to the cash that we receive, that tells us, do we have a gain or do we have a loss? Okay. I did that here, and I kind of did it here, but I did it just through journal entries, right? I looked at it from the point of debits and credits don't equal. Okay. I must have a gain. I must have a loss, right? But to calculate that amount, we're just taking the proceeds minus that book value. Okay, that's how I got the $700. That's a loss. All right. So let's look at E. The last one says, before we go there, I just want to say, what am I doing here, right? Well, I'm recording the sale of a truck for $12,000. Okay. Now the last one, E, says that this is just a straight disposal, right? Truck got stolen. I don't have insurance on this vehicle, or let me rephrase that. I don't have insurance for theft. So I'm out, right? How much am I out? Well, I'm out the book value of the asset because I'm not getting anything for that asset. Some thieves have it and Lord knows what they did with it, but I don't have it and I didn't get paid for it, right? So the first thing I need to recognize is, okay, what do I have? I'm not getting cash. So I have a loss due to theft. Or you could just say theft loss. That's fine too. How much? Well, it's the book value of the asset, $12,700. Got to get accumulated depreciation off the books, right? What's my accumulated depreciation? The accumulated depreciation is still the $11,500. So I'm going to debit accumulated depreciation for the $11,500, and then I'm going to credit the truck. I'm going to credit for what it's on our books for. It's on our books for that acquisition cost. Now, I know I'm done, right? How do I know that? Two reasons. The easiest way, debits and credits match. $24,200, $24,200. Another way I could look at that is saying, well, my book value is $12,700. I booked the loss for $12,700, so that makes sense, right? There's no gain, no loss to book. There's no gain or loss to record based on, a sale. It's just a straight loss. I lost that value. Okay. And that's, my friends, is how you do 9-5A. Okay. When we come back, we're just going to jump into chapter 10. And chapter 10 talks about accounting for liabilities. So tune back in for that one.